Hello, friends, clients, and colleagues. This is Rich Siegel with ARQ Wealth Advisors.
And this is Justin Rivera.
And today is Monday, December 2nd, a great time as we head into the final month of the year for a brief economic and market update. Justin, lots of economic data recently around jobs, inflation, interest rates. Tell us about it.
Okay. Yeah, we got another update on the GDP print for Q3. Confirmed again that we're trending at 2.8% growth, so that's a good thing, and we didn't get a downward revision there. What you will see in this left chart is the Atlanta Fed GDP estimate for Q4, and you can see a nice trend line. Starting off with a mid to low twos, and then as the election happened. And as the kind of Trump trade and administration has kind of come into power there, that the estimate for GDP is now over 3%. So above trend GDP growth estimated, obviously. Love to see that, and a lot of reasons why, obviously there from the administrative side of things. On the right-hand side, you'll see the Fed funds rate expectations moving forward. Coming into the beginning of this quarter, the expectation there was that we were going to get a 4 interest rate cuts or 100 basis points of interest rate cuts, and that is still expected for 2024. But the thing that has changed is that next year, again coming into the quarter, there was an assumption from the market and the Federal Open Market Committee of 100 basis points in 2025. But as you'll see in this chart, the market is now disagreeing, only saying that they think that we'll have 50 basis points of cuts in 2025 versus 4. Some supporting evidence for that might be this bottom left chart, which is the core PCE, and that is again the Fed's preferred inflation measure. And what you'll see here, it's a little bit small, make it a little bit bigger. What you'll see here is that in September and October, for those months specifically, we saw the PCE above 3, which made the year-over-year PCE jump from 2.7 to 2.8. So we're getting closer to that 2% target, but we're seeing inflation be a little bit sticky. We're seeing jobs market data soften up a little bit. And again, that might be a reason why the market is disagreeing with those cuts, some reasons why the Fed may pause. But again, nothing here that takes us out of the soft landing to no landing camp, and we'll keep an eye on the data.
Seems like Jerome Powell and team have so far threaded the needle. It seems like several
Yeah.
years ago, things were a little bit more precarious. I think having this monetary policy has really kind of helped us transition from this recessionary assumption to something that looks a lot more positive. So thanks for
Yeah.
covering that. Let's spend a few minutes on the stock market.
Okay. Move this down.
Yeah, thank you. All right, the Trump trade. So, whatever your politics are, the Trump trade means a few things. It means um, corporate taxes will probably stay lower. Now, under the Tax Cuts and Jobs Act several years ago, individual tax rates were going to sunset or expire. They're still scheduled to at the end of 2025, but the corporate taxes were not. So prior to that Tax Cuts and Jobs Act, the corporate tax rates in the U.S. were not competitive, 35%. They're sitting at 21%. By all accounts, that's going to be a big agenda item, is to make that permanent, maybe even lower it. Lower taxes are good for profit margins. Profit margins are good for stock prices. Um, Trump also likes less regulations. You need to have some regulations in the economy, obviously. Really, I think the biggest beneficiaries of lower regulations would immediately be the energy sector, pipelines, et cetera, and then the banking system. A lot of energy stocks and banks are in the mid and small cap space, not the mega cap technology. So we do like that space. We'll talk more about that in a moment. And then obviously lots of talks around tariffs, which is basically a tax. That would be a headwind to foreign equities. And it would cause probably higher inflation, like you said, maybe stickier inflation in that 3% range. It would also probably account for maybe higher wage inflation here. I think the biggest thing really would be kind of this renaissance in the onshoring, reshoring, nearshoring of manufacturing. And I think this is bipartisan as well, right? Under the Biden administration, you saw this CHIPS Act, and under the Trump administration, you're probably going to see a lot more of that. Industrials, just several years ago, were in the 90s, were 14% of the S&P's weighting, and now they're only 8%. So we like the industrial sector. We like manufacturing. What's really kind of interesting here, this first chart, look at what happened when Trump was elected the first time, November of 16. Look what happened just in 3 weeks. Financial stocks and small cap stocks were up 12 to 14%, whereas the S&P 500 and tech stocks were relatively flat. And then shockingly, right, same type of trend below. Trump was elected on the 6th. 3 weeks later, you see the biggest beneficiary so far was financials, up almost 10%. Small caps up 7.5%, and then the laggards again, S&P and technology. Not saying this is going to last forever, but more cyclical or economically sensitive stocks can really benefit from these types of policies. And then just to kind of look at seasonality, there's a chart on the bottom here, and you could look at the end of the year. Typically speaking, this goes back like 100 years. December is one of the strongest months of the year. The worst months of the year tend to be September, February, but strong months would be December and January. Again, past performance is not an indication of the future, but if history rhymes at all with the future, we're looking at pretty decent returns for the next couple of months. So with that, we will end by saying thanks for listening and have a wonderful holiday season and rest of the year.